Hi. Let's learn about the gambler's fallacy. The gambler's fallacy, also known as the Monte Carlo fallacy, occurs when an individual thinks that a random event is less or more likely to happen based on a previous event. However, past events do not change the probability of future events. The gambler's fallacy happens when someone misjudges whether a series of events is truly random or independent, and wrongly concludes that the outcome of the next event will be the opposite of previous events. For example, if you have flipped a coin 10 times and it landed heads up each time, you might predict that the next flip is more likely to land tails up. But each coin flip is an independent event, and the odds of the next flip landing heads up is still 50%. So, the likelihood of a fair coin turning up heads is always 50%, regardless of previous outcomes. An example of the gambler's fallacy is when people at the Casino de Monte Carlo in 1913 kept betting on red at the roulette wheel after the ball had fallen on black several times in a row. It's also seen in investing when traders sell a stock after a series of gains, thinking that a decline is now more likely. The behavior of the gambler's fallacy has been observed for over 200 years. Pierre-Simon Laplace, a French mathematician, wrote about it in his philosophical essay on probabilities. The gambler's fallacy comes from the belief in small numbers, where people think that small sample sets are always representative of larger populations or outcomes. In trading and investing, you can avoid the gambler's fallacy by not letting previous occurrences influence future outcomes. Use independent research, stay up to date on all facts, track trades and outcomes, and ask for feedback. Gambler's fallacy is the mistaken belief that a random event will occur simply because a series of the opposite of that event has taken place. It's a fallacy because random and independent events cannot influence a future outcome. Here are 4 key takeaways. 1. Gambler's fallacy refers to the erroneous thinking that a certain event is more or less likely, given a previous series of events. 2. It is also called the Monte Carlo fallacy, after the Casino de Monte Carlo in Monaco where it was observed in 1913. 3. The gambler's fallacy line of thinking is incorrect because each event should be considered independent and its results have no bearing on past or present occurrences. 4. Investors and traders often commit the gambler's fallacy when they believe that a stock will lose, or gain, value after a series of sessions that each had the opposite outcome. Hope this would help. Thanks for watching.